So you guys want to know about options trading? Alright, so today we're going to talk about options trading. Options is the right but not the obligation to buy 100 shares of a company at a premium price. So let's say the company's at $200. You don't have to like buy the whole stock for $200. You can buy an option for $20 or 0.20, which will you have to multiply that by 100, which will equal $20, and you can make more than if you bought the regular stock. That's why I usually do options trading. Alright, so one option does equal 100 shares of a company. I'll get more into that in the Robinhood account when we go over it. So when you want to trade options, you want to trade the Gucci of stocks. So you want to trade Apple, Amazon, SPY, which is S&P 500, Facebook, anything that's in the S&P 500 that you know that is in the top 500 of the United States. So an option is not like a stock. An option, you have an expiration on it. So if, let's say you buy a stock, let's say you buy Facebook for $207, you can hold Facebook for 30 years. But an option you can't, unless you buy 30 years worth of time. But usually it's anywhere from a week to I think the minimum is like 2 days, so does it go 2 days to a year. But the more time you add, the higher the premium is. I'll tell you guys what the premium is later on. And the more you'll have to pay to hold that certain option. So again, the more time you put, the more expensive it will be to hold that certain option. And the less time you have, the less it'll cost. But let's say I put a call option. A call means that I think the price will go up. Let's say I put a call option for next week on, let's say, Amazon. So if that option does not increase as I expected through the next week, that what I bought it for will decrease. So every time you get closer to the expiration date, your option decreases in value. Alright, so you're gonna want to sell the stock as quickly as you can, or the option, my bad. Let's say you buy an option for 2 weeks, and for Amazon, and you think it will go up. You're gonna want to sell that option as quickly as you can, because the closer it gets to your expiration date, the more value it loses. So let's say I buy an option for next week on Amazon, and I think I will place a call, which I think the price will go up. You're going to want to catch that move as quickly as you can, or take a longer time, like take a longer expiration date for it to fluctuate until you think you can sell it, or you want to sell it, you're comfortable selling. I would recommend at least 2 weeks of time, the minimum, so you have time for the market to fluctuate and catch more moves. So instead of buying an option for a week and then just gaining $50, you can buy an option for 2 to 3 weeks and then make maybe an extra $200 or an extra $50. Anything helps. Anything will be profit is better than not taking anything or taking less. I usually like to trade, as I said before, anything in my other videos. I like to trade anything with high volatility or high volume. Something that moves a lot in a day, like Amazon, I think it moves like 34 million units in a day, or around there, which is a lot. You want something in the millions. You don't want anything that moves like in the thousands or in the low millions, because it doesn't have that much of a change, or won't have as much of a change. So you're not gonna make as much profit or as much money as you think you will make. Alright, so now we're gonna go into the Robinhood, and I'll teach you guys how to place an option, what break even is, what out of the money, in the money, and all of that, premium, what all of that means. So let's get into the computer. Okay, so now we're on the Robinhood account. So usually Robinhood doesn't give you option trading uh, right out of the gate. So you're gonna have to apply for it. So you just go to account options and then you apply for it. Usually they accept everybody. You don't need that much of trading experience. Just trade at your own risk always, and please always learn the market, study it before you put real money into it. I mean, the only way to actually learn from the market is to put real money into it, but just learn as much as you can before. You don't want to lose $500 in one go. Alright, so we're in the Netflix stock right now, as you can see. So an option, as I said before, is the right but not the obligation to buy 100 shares of company. So like I said, you're gonna want something with high volume. You're gonna want the Gucci's of the stock, so Netflix, Amazon, Facebook, all of that. Alright, so we're gonna go into the trade Netflix options right here, and then here's the whole system. Here's the whole graph. So we're gonna talk about buying options. I don't sell options. I don't trade it because I'm not sure how to. So we're not gonna talk about that today. If you would like a video about that, just let me know and I'll be sure to do that for you guys. Alright, so you're gonna want to put buy, then you're gonna want to put either call or put. So a call is when you think the stock would go up. So let's say at 418 you think it's gonna go up to 420, 425, 500 bucks. And a put is if you think the call, and the put is if you think a stock would go down. So if it's 418, you think it's gonna go to 400, 350, 325, anything like that. So we're gonna talk about in the money, out the money, and then break even. So anything in the money for a call is below the share price. So the share price is 418, anything below that is in the money. Why? Well, because you're already making profit. So let's say you put a call, so you think it's going to go up, you're already in the right direction. The stock is heading in the right direction, meaning you're more likely to get profit. Anything out the money up here is above the share price. So 420, 425, a strike price of 430, 425. Anything here is, all of this is strike prices. So yeah, so anything out the money would be obviously cheaper than in the money because the stock has to move a lot, or not that much, but it still has to move for it to be in the money or considered in the money. All these numbers you see right here are called premiums. So it's not $8.75 for an option, it's $8.75 per share. And as I said before, one option is 100 shares. So for this option, you're actually gonna waste, or you're gonna invest $875. So here's $1,100, $1,400, $1,800, $2,000, $2,600, $3,100, and so on. So break even is if your broker lets you buy at the current price. So let's say a strike price of 418. If the share price does not go up or down, you're just gonna stay at 418. You're gonna make zero profit, but not lose anything. Just get back your $100 or how much you invested. Let's go to put. So put is the opposite from call, obviously. So put is that it goes down. So anything above the share price is in the money, and then everything under the share price is out of the money. So it's an inverse. As you can see, anything in the money is more expensive than anything out of the money. Why? Well, as I said before, if the share price is 418, anything in the money is already going in the right direction. So you put a put, and the share price is 418, anything above that is already making profit, which means you're heading in the right direction. As you can see, let's go to date, the expiration date. As I said, you're gonna want anything from 2 weeks or more. So let's put 2 weeks, June 15th. Obviously the premiums will go up in price. Why? Well, because you have more time to let the market fluctuate, which means you have a higher probability that the market will go your way. That's why if you put more time, it's more expensive. How I usually trade options is, let's say I think Netflix is gonna go down, and I'm gonna invest $100. So I put 2 weeks buy put, right? The share price 14, and I'll go all the way down and find an option for $100. Let's say 101. So I'll add it, right? So I'm buying a 330 put because the strike price is 330. An expiration of 6/19, which is June 19th. So 2 weeks, and then I'm buying the option for $1.01 per share, meaning $101. So I'm gonna put one option, as you guys can see, one option equals 100 shares, and then you're gonna want to put good for day. My max cost is gonna be 101, and then my max loss would obviously be 101. I'm not gonna lose more than 101, but I can gain more than 101. I can make $300, 300% return, which would give me a $303 profit on top. So I would get my 101 back plus another $303 profit. So we'll then put review. As you can see, I don't have enough money because I already have $200 invested in Apple and Netflix. So right here it would say done, so you would click done, but in my case I'm gonna put cancel. All I'm teaching you guys is exactly how I trade. Like, we can go down here, and then where's 370? I think I have it for June. Why did I go a week ago? Alright, here, see, I have one option for $97. So yeah, option is you can invest small to gain bigger, and it's riskier, but it's a calculated risk. So why do I say it's a calculated risk? Because you know how much you're gonna lose. So let's say you want to invest in Netflix, right? Let's say you buy the whole stock of Netflix. So you buy $418 of Netflix, and let's say you bought it at 14, right? And the next month Netflix can crash, and you will lose the $418. So you really not sure, because you don't know how much or how the market will react for the next following months, years, or decades. But the difference in an option is, if you invest $100 in Netflix, you know you're only gonna lose $100 if it doesn't go your way. You're not gonna lose more than $100, but you can gain more than $100 profit. In Netflix, you're only making, let's say if I bought it at 413, and I sold it at 419, I'm only making $6 profit, which is not much. But if I were to invest, I think it's $1,000, right? Because I'm gonna put the strike price at 416, so it's probably like $1,000. I can make for 416 or 419 is 3. I can make probably 300, if I'm not wrong, $300. I mean, it's a lot of investing, but let's just do some quick math for you. So let's go back to trading options, right? Let's say I'm gonna put a call. Let's say the share price is 418, right? I'll put a strike price of 419, right? So I'm investing $1,400, so 410. We're gonna go to calculator. Let's reset this. So 410, right? That's my strike price. Let's say the stock goes all the way down to 370, right? So 370, so minus 370. So that's your strike price. That's where it went. It would equal 40, right? You're gonna want to multiply that by 100 because you have 100 shares of it. You're making $4,000 profit by just investing $1,480. So you're making almost 3%. I mean, 3 times what you invested. Not even 3.5 times what you invested. That's more than you'll ever do if you were to buy $1,400 of Netflix as the stock itself. You would only make max $100. So options, as I said, it gives you more leverage to gain, but it's also a higher risk. But it's a calculated risk. As I said, always always study, learn the market, learn the patterns, and invest at your own risk. Don't invest more than you think you should. Invest something you're comfortable with, so that way if you take a loss, you're not like, oh, I suck, I'm never gonna trade again. So just trade something you're comfortable with. Trade for a lot, like trade something you're comfortable with, and if you lose it, don't get discouraged and know losses happen, and then just wait for another confirmation or see what the market has to offer so you can invest again. Alright guys, so I hope you guys like this video. I kind of wanted to go over options and how I trade them. I know it's kind of a lengthy video, but I just wanted to make sure I left everything on the table. And if you guys have any other questions, just leave a comment or send me a DM on my Instagram. I'll leave it in the description below. I kind of went over like the questions I had when I started, and I try to go like not as in depth as if I would if I was explaining to someone else, like explaining to someone that already had experience. But if you guys would want like a more in-depth video, just let me know, and then I'll be sure to make it for you guys. Like telling you how like where to trade or where to place an option. Like so I see this pattern and I think it's gonna go up, so I'm gonna place an option for a call or anything like that. Once again, an option is a great way to make money, but it's very risky. But it's a calculated risk because you know how much you're gonna lose, but your potential gain is insane. Always remember that an option is a right, but not the obligation to buy 100 shares of a company. You can buy it, but you don't have to. Also, try to find something that you find value in. So Facebook, Amazon, find a stock that you find value in. That way you're more invested in researching it and like learning from it. So like, I'm gonna invest my time to like learn how Facebook reacts to this type of resistance, what happens when it does head and shoulders or anything like that, or when it's in an uptrend and it hits resistance or a support level. Just get invested. Please learn. I can't stress this enough. I don't want you guys going there and then losing $700 because you didn't take the time to invest in yourself and learn. Watch my videos, watch other people's videos, and like try to learn the basics. Then go for yourself, look at the charts for a couple months, see how that stock reacts to certain things, and then when you feel confident, put some money in your account and then start investing. You don't have to invest a lot. You can invest little, like $10, $20. I have a video about that. I'll leave it in the description also. So yeah guys, thank you guys for watching, and then stay safe. I'll see you guys in the next video.